Before we begin, please remember that I am not a licensed financial advisor, and this presentation is for educational and informational purposes only. The information provided in this video should not be considered legal or financial advice. You should consult with a qualified professional before making any financial decisions. You just did it. You signed a mountain of paperwork, your hand is cramping, but it doesn't matter. The keys are in your hand. This is it. Your first home. Your dream home. You walk through the empty rooms, imagining your future, the life you're going to build. It's one of the best days of your life. Then a week later a letter arrives. It looks official. It has your name on it, your new address, and even the name of your mortgage lender. It talks about an urgent, time-sensitive offer for mortgage protection. It warns you that if you were to pass away unexpectedly, your family could lose this dream home to foreclosure. Your heart sinks. The fear is immediate and visceral. You think about your spouse, your kids, and the thought of them being forced out of this house is unbearable. So you fill out the form, you make the call, and you sign up. And in that moment of fear, you have likely just been sold one of the most overpriced and restrictive financial products on the market. This is the story of mortgage protection insurance, or MPI. And my promise to you in this video is simple. I am going to pull back the curtain on this entire industry. I'm going to show you exactly how these companies use your new public home record and your deepest fears to sell you a policy that primarily benefits one entity, your bank. By the end of this video, you will understand what MPI really is, why it's almost never the right choice for American homeowners, and most importantly, what the smarter, cheaper, and more flexible alternative is that will actually protect your family's future in their home. You are going to save thousands of dollars and gain the peace of mind that comes from making an informed decision, not one based on a cleverly disguised sales letter. So let's start with the psychology, because that's where they get you. Buying a home is the biggest financial transaction of most people's lives. It's overwhelming. You're dealing with realtors, loan officers, inspectors, appraisers. Your brain is flooded with new terms, new documents, new responsibilities. You are financially and emotionally exhausted. And it's in this exact state of vulnerability that the MPI industry strikes. They know you've just taken on hundreds of thousands of dollars in debt. They know your name and address are now a matter of public record, which is how they get your information so quickly. And they know that the primal fear of leaving your family unprotected is at an all-time high. So they craft these mailers to look like they're coming directly from your lender. They use phrases like final notice, important mortgage information, or response required. They're designed to create a sense of urgency and obligation, to make you feel like this is a mandatory part of your mortgage, just like homeowners insurance or property taxes. It's not. It is a completely optional third-party product. But the marketing is so effective that millions of homeowners sign up, thinking they're doing the responsible thing. They believe they are buying protection for their family, when in reality they're buying protection for their bank's bottom line. Let's break down exactly what mortgage protection insurance is. In the simplest terms, MPI is a type of life insurance policy designed to do one thing and one thing only: pay off your outstanding mortgage balance if you die. That sounds good on the surface, right? You die, the mortgage disappears, your family owns the home free and clear. It's the ultimate sales pitch. But the devil, as always, is in the details. And the details of these policies are where the picture starts to get very, very ugly for the consumer. The first major problem is who gets the money. With a traditional life insurance policy, if you pass away, the death benefit, that big tax-free lump sum of cash, goes directly to your chosen beneficiary. Your spouse, your kids, your estate. They get the money, and they have complete freedom to decide how to use it. They could pay off the mortgage, yes, but they could also use it to cover other immediate expenses like funeral costs, car payments, or childcare. They could use it to replace your lost income for a few years while they get back on their feet. They could invest it for their future. The point is, they are in control. They can assess their new financial reality and make the best decision for their unique situation. With mortgage protection insurance, you don't have that choice. The beneficiary is not your family. The beneficiary is the bank, the mortgage lender. If you die, the insurance company writes a check directly to the lender to pay off the loan. Your family never sees a dime of that money. They're left with a paid-off house, which is certainly better than nothing, but they're also left with zero cash to handle all the other financial emergencies that arise when a primary breadwinner is suddenly gone. What if they needed that cash more than they needed a paid-off house? What if selling the house and downsizing was actually the smarter financial move for them? With MPI, that choice is taken away from them. The decision has already been made. The bank gets paid first and your family gets whatever is left, which in this case is just the house itself with no liquid cash from the policy to maintain it. The second, and arguably more insidious problem with MPI is the concept of a decreasing benefit. When you buy a traditional term life insurance policy for, say, $500,000, that death benefit is level. It's $500,000 on day one, and it's still $500,000 in year 29 of a 30-year term. It doesn't change. Your family is guaranteed that full amount no matter when you pass away during the term. Mortgage protection insurance works in the complete opposite way. The value of your policy decreases over time, right alongside your mortgage balance. Think about it. In year one, you might owe $400,000 on your home. If you die, the policy pays out $400,000 to the bank. But 20 years later, you've been diligently making payments, and now you only owe $150,000. If you die then, the policy only pays out $150,000, pays whatever is left on the loan. But here's the kicker. While the potential payout is constantly shrinking your monthly premium, the amount you pay for this coverage almost always stays the same. You are paying the same fixed price every single month for a benefit that is worth less and less each year. It's like paying for a full gallon of gas every week but only being allowed to put half a gallon in your tank, then a quarter gallon, then just a few drops, all while paying the full price. It's a terrible deal for you, but an incredibly profitable model for the insurance company. They are taking on less risk every single month, while you continue to pay them as if their risk is still at its peak. It's a financial structure that is fundamentally designed to work against the homeowner. And this is just scratching the surface of the problems baked into this product. Let's peel back the first layer. It's a detail so fundamental, so critically important, that it's almost unbelievable it's not the headline of every single offer. And that is, who actually gets the money? When you buy a life insurance policy, you name a beneficiary. Your spouse, your kids, a trust. It's the person or people you want to receive the money when you're gone so they can use it for whatever they need most. With mortgage protection insurance, you don't get that choice. The sole, unchangeable beneficiary of your policy is the bank, the lender, the mortgage company. Let that sink in for a moment. You are paying a monthly premium for years, sometimes decades, for an insurance policy that is legally obligated to pay a multi-billion-dollar financial institution instead of your grieving family. The check doesn't go to your spouse to help them navigate the single most difficult period of their life. It doesn't go into an account for your children's future education. It doesn't pay for funeral expenses, or cover the sudden loss of income, or keep the lights on and food on the table. It goes directly to the lender to wipe out the loan balance. Now on the surface you might think, well, isn't that the point? To pay off the house. And yes, that's the sales pitch. But it completely strips your family of the single most important thing they need in a crisis: options. It removes their financial flexibility at the precise moment they need it most. Imagine this scenario. A husband and wife, let's call them Mark and Sarah, have a $400,000 mortgage with a low 3% interest rate. Their payment is a manageable $1,686 a month. They have 2 young kids. They buy a mortgage protection policy, thinking they're doing the responsible thing. Tragically, Mark passes away unexpectedly. Sarah is left to pick up the pieces both emotionally and financially. The mortgage protection insurance kicks in. The insurance company writes a check for the remaining $380,000 on the mortgage directly to the bank. Poof! The mortgage is gone. The salesperson would call this a victory. But is it? Sarah now owns a home outright, but she has zero cash. She just lost half of her household income. She has immediate, crushing expenses. The funeral alone costs $10,000. The car needs a major repair. The kids need new clothes for school. She needs time off work to grieve and get her life in order. But the bills don't stop. She has this massive illiquid asset, a paid-off house, but she can't use it to buy groceries. She has no emergency fund. The insurance money that could have been a lifeline, a cash cushion to give her breathing room and stability, was instead used to pay off a low-interest debt that was perfectly manageable. Now, what if instead of MPI, Mark had a standard term life insurance policy for the same amount? When he passed, the insurance company would have sent Sarah a tax-free check for $380,000. The money is hers. The power is hers. She can now think like a CFO of her own family. She can look at that manageable $1,686 mortgage payment at 3% interest and say, you know what? Inflation is running at 4%. My money is better off invested or sitting in a high-yield savings account earning 5% than it is paying off this cheap debt. She could take a portion of that money, say $100,000, and put it in a safe account that covers the mortgage payments for the next 5 years, giving her an incredible peace of mind. She can use another portion for immediate expenses and to replace Mark's lost income for a year or two, while she figures out her next steps. She can invest the rest for her long-term future and the kids' college education. She has control. She has freedom. Mortgage protection insurance steals that freedom and gives it to the bank. It makes the decision for your family, and it almost always makes the wrong one because it solves a problem they might not have, the mortgage payment, while ignoring the immediate crisis they definitely do have, a lack of cash. But the beneficiary issue, as glaring as it is only the second major flaw. The third is even more insidious. It's a practice known as post-claim underwriting. It sounds boring and technical, but it is a landmine buried in the fine print of many of these policies. Here's how it works. When you apply for a traditional term life insurance policy, the company does its homework up front. This is called full underwriting. They check your medical records, they might ask for a simple medical exam, and they review your application thoroughly before they approve you and take your first dollar. It can be a bit of a hassle, but once you are approved, your policy is a rock-solid contract. As long as you were truthful on your application and you pay your premiums, they have to pay the claim. Many mortgage protection policies are sold differently. They use what's called simplified underwriting or guaranteed acceptance. The sales pitch is all about convenience. No medical exam needed. Just answer a few simple questions. Get covered in minutes. It sounds fantastic. Feels easy. But what they don't tell you is that they are deferring the real underwriting process until the worst possible moment. After your family has filed a claim. This is post-claim underwriting. You sign up, you start paying your premiums every month for 5, 10, 15 years, believing you have a safety net. Then, when the unthinkable happens and your family needs that money, the insurance company launches the investigation they should have done at the very beginning. They will pull every medical record they can find going back years. They will scrutinize your original application with a microscope, looking for any mistake, any omission, any tiny discrepancy they can use to deny the claim. Did you forget to mention you saw a doctor for back pain 7 years ago? Denied. Did you check no to having high cholesterol because you didn't know you had it, but a blood test a year later showed it was slightly elevated? Denied. They are looking for a reason to retroactively void the policy, refund the premiums you paid, and walk away, leaving your family with nothing but a handful of returned checks at the exact moment they were counting on a massive payout. It is a business model that preys on the sick and grieving. It's like a fire department selling you a fire extinguisher, and only after your house burns down do they test it to see if it ever worked in the first place. It's a cruel and deceptive practice that is rampant in the world of simplified issue insurance. And if that weren't enough, there's a fourth fundamental problem. These policies are not portable. Mortgage protection insurance is tied to one thing and one thing only, your current mortgage. The moment that mortgage ceases to exist, so does your insurance policy. What does that mean in the real world? It means if you sell your house and move, your policy is gone. More importantly, if you refinance your mortgage to take advantage of lower interest rates, one of the smartest financial moves a homeowner can make. Your original mortgage is paid off and a new one is created. And just like that, your mortgage protection policy evaporates. All those premiums you paid for years? Gone. To get new coverage, you have to start all over again. But you're older now. Maybe you've developed a health condition in the intervening years. Your rates for a new policy, if you can even qualify, will be dramatically higher. You are effectively penalized for making a good financial decision. A proper term life insurance policy, on the other hand, belongs to you, not your loan. It is completely independent of your house. You can refinance a dozen times, you can move to a new state, you can sell your house and rent for a decade, it doesn't matter. Your coverage and your locked-in premium remain exactly the same. It provides a stable, predictable foundation of security that isn't tied to the whims of the real estate market or interest rates. It's designed to protect your family, not your bank's loan document. Now, on the flip side of that coin is a product you've probably seen advertised, maybe even in the stack of mail you got right after you closed on your house. It's called Mortgage Protection Insurance, or MPI. And at first glance, it sounds like the perfect tailor-made solution. The name itself is brilliant marketing. Mortgage, protection, insurance. It does exactly what it says on the tin, right? It protects your mortgage. When you're a new homeowner, you are in a uniquely vulnerable position. You've just signed more documents than you've probably signed in your entire life. Your hand is cramping, your mind is swimming with numbers, escrow, PMI, property taxes, interest rates. You're exhausted, but you're also euphoric. You have the keys. This is it. Then an offer lands in your mailbox or on your screen from your lender or a third-party company. It says, "Protect your new home, the biggest investment of your life. With one simple policy, we'll pay off your mortgage if you die. No medical exam needed. Just check this box." It's the siren song of convenience. It feels like the responsible adult thing to do. One less thing to worry about. You check the box, you sign the form, and you feel a wave of relief. Your family is protected. But what have you actually bought? This is where we need to pull back the curtain and look at the machinery of these policies, because the convenience you're paying for often comes at a steep, and sometimes hidden, cost. The first, and arguably the most shocking, difference between term life insurance and most MPI policies is something called a declining benefit. Let's break that down. With the term life policy we just discussed, if you buy a $500,000 policy for 30 years, that death benefit is $500,000 on day 1, and it's still $500,000 on day 10,950, the very last day of the term. It's a flat, level benefit. Your family gets the full face value, no matter when the unthinkable happens. Mortgage protection insurance works in the complete opposite way. The benefit, the amount of money it will actually pay out, is designed to decrease over time. Why? Because it's not tied to your family's needs. It's tied directly to your mortgage balance. Every single month you make a mortgage payment. And with each payment you chip away at that principal loan amount. Your mortgage balance goes down. And as your mortgage balance goes down, so does the potential payout from your MPI policy. Think about it like this. Imagine you subscribe to a pizza delivery service. You agree to pay $30 every single month for 30 years. The first month they deliver a beautiful large pizza with 8 slices. The next month you pay the same $30, but they deliver a pizza with 7 slices. The month after that it's 6 slices. For 30 years you pay the exact same premium, but the amount of pizza you get shrinks every single month until at the end you're paying $30 for an empty box. You would cancel that subscription immediately. It's an absurd deal. Yet, this is the fundamental structure of most mortgage protection insurance policies. Your premium, the amount you pay every month, typically stays the same for the life of the policy. It's locked in. But the benefit, the thing you're actually paying for, is in a constant state of decline. In year 1, if you pass away, it might pay off your $495,000 remaining balance. But in year 25, when you've been a faithful customer for a quarter of a century and paid tens of thousands in premiums, it might only pay off the remaining $80,000 on your loan. You paid the same premium in year 25 as you did in year 1, but for a fraction of the coverage. When you compare that to a level term policy, where the payout would have remained at the full $500,000, the difference in value is staggering. But the declining benefit is only the first part of the story. The second critical difference is perhaps even more important. Who gets the money? This is the question of the beneficiary. In a term life insurance policy, you, the policyholder, name the beneficiary. Overwhelmingly, people name their spouse, their children, or a trust set up for their family. This means if you die, the insurance company writes a tax-free check directly to the people you love. Your family. They receive that cash and they are in complete control. They are in the driver's seat. They can assess their new financial reality and make the best possible decisions. Maybe the smartest move is to pay off the mortgage entirely and eliminate that monthly payment. Fantastic. But maybe it's not. Maybe the mortgage has a really low 2.5% interest rate, and they have $30,000 in high-interest credit card debt and car loans at 9%. It might be far smarter to pay off those toxic debts first. Maybe they need cash for immediate funeral expenses. Maybe your spouse needs to take 6 months off work to grieve and stabilize the family, and they need the money to replace your lost income. Maybe they need to set money aside for the kids' college education. The point is, the money is theirs. It's liquid. It provides maximum flexibility during the most difficult time of their lives. Now let's look at mortgage protection insurance. Who is the beneficiary on an MPI policy? It's not your family. It's the bank, the lender. If you die, the insurance payment goes directly to your mortgage lender to pay off the outstanding loan balance. Your family never sees a dime of that money. They never get to make a choice. The decision is made for them. The house is paid off, period. And while that sounds good on the surface, it strips your family of all the flexibility we just talked about. What if they needed that cash for more pressing issues? What if selling the house and downsizing was actually the best financial move for them, and they could have used that insurance money to bridge the gap and set up their new life? With MPI, that option is gone. The policy serves one master: the lender's balance sheet. Its sole purpose is to make the bank whole. It protects the bank's asset, the loan. Your family's broader financial well-being is a secondary concern, if it's a concern at all. So while a term life policy gives your family a check and a world of options, an MPI policy simply gives them a paid-off house and nothing else. This brings us to the third major point of comparison: the cost and the underwriting process. Underwriting is the process an insurance company uses to figure out how risky you are to insure. For a traditional term life policy, this usually involves a detailed application, a review of your medical records, and often a simple medical exam with a blood and urine sample. It's a bit of a hassle, I'll grant you that. Takes some time and effort, but that detailed process allows the insurance company to get a very accurate picture of your personal health and lifestyle. If you're a healthy non-smoker, you are a low risk. And because you're a low risk, they can offer you a much lower premium. You are rewarded for your good health with a better price. Many MPI policies, on the other hand, are sold as simplified issue or guaranteed issue. This is a major selling point. No medical exam. Sometimes just a few health questions. Sometimes not even that. This sounds amazing, right? It's fast, it's easy, no needles. But how can they do that? How can they insure you without knowing anything about your health? They do it by assuming the worst. Or rather, they just pull everyone together, the marathon runners and the chain smokers, the 30-year-olds and the 60-year-olds, and charge a price that's high enough to cover the average risk of that entire group. This means that if you are young and healthy, you are almost certainly overpaying. You are subsidizing the higher risk of the less healthy people in the pool. It's like having a one-size-fits-all price tag for a car. The person buying the brand new luxury sedan pays the same as the person buying the 15-year-old clunker. It's a great deal for the person with the clunker, but a terrible deal for everyone else. So, when you combine these three factors, a declining benefit that shrinks over time, a rigid payout that only goes to the bank, and a higher cost, especially for healthy individuals, the picture becomes clear. The convenience of mortgage protection insurance often masks a product that is less flexible, offers decreasing value, and costs more than the alternative. It's designed around the loan, not around your life. It's built for the lender, not for your legacy. So let's talk about that legacy. Let's talk about what a protection plan built for your life actually looks like. Because it exists. It's not a secret, but it's often overshadowed by the convenience-packaged marketing of MPI. It's called term life insurance. And when you place it side by side with mortgage protection insurance, the difference isn't just noticeable. It's a chasm. It's the difference between buying a tool that does one specific job and owning a multi-tool that can save you in 100 different situations. The single most important difference, the one that should stop you in your tracks, is the beneficiary. Who gets the money? With mortgage protection insurance, the beneficiary is locked in. It's your mortgage lender. The bank. Period. If you pass away, the insurance company writes a check directly to the institution that holds your loan. Your family never sees a dime of it. The house is paid off, which sounds great on the surface, but it's a transaction that happens over their heads, without their input or control. Now, contrast that with a standard term life insurance policy. Who is the beneficiary? Whoever you choose. Your spouse. Your children. A trust set up for your family's future. The money, a tax-free lump sum, goes directly into their hands. This isn't a small detail. It is the entire point. It transfers power from the bank to your family at the moment they need it most. Let's walk through a scenario. Imagine the worst has happened. A family is grieving the loss of a primary breadwinner. If they have mortgage protection insurance, they get a letter in the mail, maybe a call, informing them the mortgage has been satisfied. The debt is gone, but so is the cash. They now own a house free and clear, but they still have car payments. They still have grocery bills. They have looming college tuition payments. They might have unexpected medical bills from a final illness. They have zero liquid assets from the policy to deal with the immediate, crushing financial realities of life. They are, as they say, house rich and cash poor, at the worst possible time. The MPI did its one and only job. It protected the bank's asset. Now let's rewind that same tragic scenario. But this time, the family has a term life insurance policy. A check for, let's say, $500,000 arrives. It's made out to the surviving spouse. Now they have options. They have control. They can sit down at the kitchen table, take a deep breath, and make a plan. They can look at their financial situation holistically. Maybe paying off the entire mortgage immediately is the best move. Great, they can write that check themselves. But maybe their mortgage has a very low 3% interest rate. And maybe, just maybe, they need that cash for more pressing concerns. Maybe they use a portion of it to cover funeral expenses and pay off high-interest credit card debt. Maybe they set aside a large chunk for the kids' education. Maybe they invest the rest to generate a small income to replace the lost salary, allowing them to keep making the low-interest mortgage payments while they get back on their feet. The term life policy gives them the gift of choice, treats them like adults. It trusts them to know what's best for their own family. MPI makes the decision for them. This leads us to the second massive difference: the value of the payout itself. Mortgage protection insurance is almost always a decreasing benefit policy. This sounds complicated, but it's brutally simple. The potential payout shrinks over time, mirroring your mortgage balance. In year 1 of your 30-year mortgage, you owe, say, $400,000. The MPI policy will pay out $400,000. But in year 25, you might only owe $80,000. The MPI policy will now only pay out $80,000. Here's the kicker. In most cases, your monthly premium, the amount you pay for this shrinking coverage, stays the same for the entire life of the loan. You are paying the same price for a benefit that is constantly losing value year after year. It's like paying for a full pizza every month but only getting one slice delivered by the end. Term life insurance, on the other hand, is a level benefit policy. The name says it all. If you buy a $500,000 30-year term policy, that death benefit is $500,000 on day 1, and it's $500,000 on the very last day of the 30th year. It never decreases. Your premium is also locked in. It never increases. You know exactly what you're paying and exactly what your family will get. The value is consistent, predictable, and transparent. So, as you pay down your mortgage and build equity, the gap between what your family owes and what your family receives from the insurance policy grows. That surplus is wealth. It's security. It's the legacy we were talking about. With MPI, there is no surplus. Ever. The policy is designed to only ever bring the debt to zero, nothing more. Let's talk dollars and cents. You might be thinking, well, the MPI must be cheaper because it offers less. And you would be making a perfectly logical assumption. But in the strange world of insurance, you would almost always be wrong. Because term life insurance policies are fully medically underwritten, and MPI policies often are not, the pricing is worlds apart. Medically underwritten means you go through a health screening, a questionnaire, maybe a simple medical exam. The insurance company assesses your individual risk. If you're a healthy non-smoker, you get rewarded with a much lower rate. You are not subsidizing the risk of others. MPI, on the other hand, is often sold with simplified or guaranteed issue underwriting. No medical exam needed. Sounds convenient, right? But what it really means is the insurance company is taking on a blind pool of risk. They have to assume that the group includes people with serious health conditions. So, to protect themselves, they charge everyone a higher premium. The healthy people pay more to cover the costs of the unhealthy people. So, a healthy 35-year-old could often get a $1 million 30-year term life policy for significantly less than a $400,000 decreasing benefit MPI policy. Let me repeat that: more than double the coverage for a longer period with a guaranteed level payout for less money. It seems too good to be true, but it's simply the result of a more competitive and precise marketplace. Finally, there's the issue of portability. Your life isn't static. You might move. You might sell your home and buy a new one. You might refinance your mortgage to get a better interest rate. What happens to your mortgage protection insurance then? It's gone. The policy is tied to that specific loan, that specific mortgage number. When that loan ceases to exist, so does your coverage. If you want protection on your new home or your new refinanced loan, you have to apply all over again. And now you're older. You might have developed a health condition. Your rates will be higher, assuming you can even qualify. Your term life insurance policy? It doesn't care about your mortgage. It isn't tied to your address. It's tied to you. It's your personal financial shield. You can move 10 times, refinance 5 times, it doesn't matter. The policy stays with you unchanged, with the same premium and the same death benefit you locked in years ago. It provides a stable, predictable foundation in a life that is anything but. So when you stack them up, it becomes clear. One policy pays the bank, the other pays your family. One policy shrinks in value every single month, the other remains steadfast. One policy dictates how the money is used, the other provides freedom and options. One is often more expensive for far less coverage, and the other provides incredible value. One vanishes when you change your loan, the other follows you through life. This isn't a comparison of two equal products. It's a comparison between a restrictive, single-purpose product sold for convenience and a flexible, powerful financial tool designed to protect what actually matters: your family's future. It's a choice between protecting a loan and protecting a life. So let's put this choice into the real world. Imagine a young couple. Let's call them Alex and Ben. They just closed on their first home. It's a 3-bedroom ranch in a decent school district, the biggest financial commitment they've ever made. The excitement is electric, but underneath it, there's a quiet hum of anxiety. The mortgage payment is manageable, but what if something happened to one of them? A few weeks after they move in, a letter arrives. It looks official, bearing the name of their mortgage lender. It's not a bill, but an offer. An exclusive, time-sensitive offer for something called mortgage protection insurance. The letter is expertly written. It uses words like security, peace of mind, and protect your family's home. It promises that if Alex or Ben were to pass away, their mortgage would be paid off in full. No questions asked. No burden left on the surviving partner. And the best part? So easy. No medical exam, just a few questions on a form. They can roll the premium right into their mortgage payment. It feels like a safety net, conveniently packaged and delivered right to their door by the very institution they just entrusted with their financial future. To Alex and Ben, tired from unpacking boxes and navigating new homeowner responsibilities, this sounds perfect. It's one less thing to worry about. They almost sign up on the spot. But then Ben, who's a bit of a skeptic, pauses. He asks a simple question that changes everything. Wait, who actually gets the money? They read the fine print. The beneficiary of this policy isn't Alex. It isn't Ben. The beneficiary is the bank. Let that sink in. If something tragic happened, the insurance company wouldn't write a check to the grieving family. They would write a check directly to the lender to pay off the loan. The family never sees a dime. Now, on the surface, that might sound okay. The mortgage is gone, right? That's the goal. But this single detail is the key that unlocks why this product is so fundamentally flawed for the consumer. It strips away the single most important thing a life insurance payout should provide: choice. If Alex were to pass away, Ben would be grieving. He'd be trying to figure out how to be a single parent, how to manage a household on one income. Maybe paying off the house immediately isn't the smartest financial move. Maybe he needs that money for childcare, for daily living expenses, to create a college fund, or simply to take some unpaid time off work to be with his kids and heal. With mortgage protection insurance, he has zero options. The decision is made for him. The asset, the house, is secured for the bank, but the family's immediate cash flow needs are completely ignored. This leads them to a second, even more troubling discovery. They look at their mortgage amortization schedule. In the first few years, most of their payment goes toward interest. The principal, the actual loan balance, goes down very slowly. But their MPI policy has a decreasing benefit. This means that as they diligently pay their mortgage each month, the potential payout from the insurance policy shrinks. If they have a $400,000 mortgage, the policy might pay out close to that in year 1. But in year 15, when they've paid the balance down to $250,000, that's all the policy will pay. In year 29, when they owe just $15,000, the death benefit is only $15,000. Here's the kicker. In most cases, the premium they pay every month for this shrinking coverage stays exactly the same. They are paying the same price for a benefit that is constantly losing value. It's like paying for a full gallon of gas every week, but the pump gives you a little less each time until you're paying the full price for just a cup of fuel. It's a terrible deal, mathematically speaking. So, Alex and Ben decide to do a little comparison shopping. They're both in their early 30s and in good health. Ben goes online and gets a quote for a 30-year term life insurance policy, the kind we talked about earlier. He asks for a $500,000 policy, more than enough to cover their $400,000 mortgage. The quote that comes back shocks them. It's about $40 a month. The mortgage protection insurance offered by their lender was quoted at over $60 a month. So let's break down that comparison. Option A, mortgage protection insurance. For $60 a month, they get a policy that pays the bank, not their family. The benefit amount decreases every single month. By the end of the loan, it's worth next to nothing. Option B, term life insurance. For $40 a month, a full 33% cheaper, they get a policy that pays $500,000 directly to the surviving spouse tax-free. That $500,000 benefit is guaranteed. It's $500,000 on day 1, and it's still $500,000 in the final month of the 30-year term. The premium is locked in and will never increase. With that $500,000, the surviving partner has total control. They could choose to pay off the mortgage, absolutely. But they'd still have $100,000 left over. That leftover cash could cover funeral expenses, pay off high-interest credit card debt, fund a 529 college plan, or simply serve as an emergency fund to replace the lost income for a few years while they get back on their feet. Or maybe they decide not to pay off the mortgage. Maybe the interest rate on their mortgage is a low 3%, and they can earn 8% by investing that money instead. They could use the insurance payout to generate an income stream that more than covers the mortgage payment. While the principal of the payout continues to grow, they have the freedom to make the best decision for their family at that specific terrible moment in time. This is the fundamental difference. Mortgage protection insurance is a rigid, one-trick pony. It solves one problem, paying off a specific debt to a specific lender. Term life insurance is a versatile financial Swiss Army knife. It provides a lump sum of tax-free cash that can solve any number of problems, giving the family the power and dignity of choice during the worst time of their lives. But what about that no medical exam feature? That's the big selling point, right? The convenience. Well, this convenience comes at a steep price, and not just in dollars. These policies are often what's called simplified issue or guaranteed issue. The insurance company is taking on a risk without knowing your full health history. To compensate for that unknown risk, they do two things. First, they charge everyone a higher premium. Healthy people like Alex and Ben end up subsidizing the risk of less healthy applicants. Second, and this is critically important, these policies often have a 2-year contestability period. This means if the insured person dies from a non-accidental death within the first 2 years of the policy, the company can investigate their medical history. If they find any evidence that the person had a pre-existing condition they didn't disclose, even if they didn't know about it, the company can deny the claim and simply refund the premiums paid. All that peace of mind vanishes. A fully underwritten term life policy, the kind Alex and Ben got a quote for, does require a medical exam. It might take a few weeks to get approved, but that process is what allows the insurance company to accurately assess the risk and offer a healthy 30-year-old a massive amount of coverage for an incredibly low price. And once it's in force, it's rock solid. For our couple, Alex and Ben, the choice became crystal clear. The official-looking letter from their lender wasn't an offer of protection for their family. It was an offer of protection for the bank, cleverly marketed as a family product. It was an offer of convenience at the cost of value, flexibility, and control. They shredded the letter and submitted their application for a 30-year term life policy instead. They realized they didn't just need to protect their mortgage. They needed to protect their entire way of life. So if the math is this clear, if the value proposition is so lopsided, why on earth do people still buy mortgage protection insurance? The answer lies in psychology, marketing, and the moments of vulnerability we all face. The human brain is a funny thing. We can be incredibly rational, capable of calculating interest rates, comparing amortization schedules, and navigating the labyrinth of a 30-year mortgage. But we are also deeply emotional creatures, driven by instincts that were wired into our DNA long before the concept of a mortgage even existed. And the single most powerful instinct we have is the drive to protect our family, our home, our sanctuary. When you sign those closing documents, you're not just taking on debt. You're making a promise to your partner, to your children, to yourself. A promise of stability, of memories, of a place to call your own. That moment is a peak of both excitement and profound vulnerability. You've just signed your name to the biggest financial commitment of your life. The weight of that responsibility is immense. And then a few weeks later, a letter arrives. It doesn't look like junk mail. It's in a serious-looking brown or white envelope. It might have a red urgent or final notice stamp on it. The return address is vague, something official sounding like Homeowner Services Division or Mortgage Protection Center. Inside, the letter mentions your name. It mentions your mortgage lender. It might even mention the exact amount of your loan. It speaks of a limited time to enroll in a program to ensure your family won't lose their home if you die. Your heart rate quickens just a little. How did they get this information? Is this from my bank? Is this something I was supposed to sign up for at closing? The letter is expertly designed to short-circuit your rational brain and trigger your most primal fear. The fear of failing to protect your family. This is the first gear in the mortgage protection marketing machine. And it's a machine built on a foundation of public records. When you buy a home, the deed, your name, your address, your lender, and the loan amount become public information, filed with the county. These MPI companies subscribe to services that scrape this data the moment it becomes available. They know you're a new homeowner. They know you're in that peak state of vulnerability, and they time their mailings to hit you right when that anxiety is at its highest. They are weaponizing your own personal information against you, cloaking a sales pitch in the guise of an official notification from your lender. It's a brilliant, if not deeply cynical marketing tactic. The goal is to create confusion and urgency to make you feel that you must respond, that you're being irresponsible if you don't. Let's say you fill out the little card and mail it back. What happens next? You've just invited the second gear of the machine into your life, the high-pressure sales agent. These agents are often not salaried employees. They are independent contractors working on pure commission. Their income depends entirely on their ability to close a sale right then and there. They are masters of emotional leverage. They won't be talking about declining benefit amounts or non-transferable policies. They will be sitting in your living room, the one you just bought, and they will be painting a picture. A very dark picture. They'll ask you, if you were to get in a car accident on the way home from work tomorrow, what would happen to your spouse? How would they make these mortgage payments alone? Would they have to sell this beautiful home you just bought? Would your kids have to change schools? They are selling a feeling. They are selling the immediate relief from the anxiety they just induced. The policy itself is secondary. The product is peace of mind, delivered in a convenient one-time transaction. They'll emphasize how easy it is. No medical exam needed. We can get you approved right now. Just a few signatures and you can sleep soundly tonight knowing your family is protected. This is the simplicity trap. In a world of complexity, we crave simple solutions. The thought of shopping for term life insurance, comparing quotes, filling out long applications, scheduling a medical exam, feels daunting, especially when you're already exhausted from the home buying process. This is a classic case of decision fatigue. Your brain, having made thousands of micro-decisions to get you into this house, is now looking for the easiest path forward. The MPI salesperson presents that path on a silver platter. They're not selling a financial product. They're selling the absence of a headache. They are counting on you being too tired, too overwhelmed, or too intimidated to ask the hard questions. They are counting on you to value convenience over value. And let's be clear about the no medical exam feature. This is not a benefit for you. It's a benefit for the insurance company. They aren't doing it to be nice or to make your life easier. They're doing it because it allows them to charge everyone a much higher premium to cover the unknown risk they're taking on. It's called simplified or guaranteed issue underwriting. By not checking your health, they just assume the worst and charge accordingly. A healthy person in their 30s or 40s ends up massively subsidizing the risk of everyone else in the pool, paying a premium that is completely disconnected from their actual risk profile. Furthermore, these no-exam policies often come with a 2-year contestability period and a host of pre-existing condition clauses buried in the fine print. If you die within the first 2 years from a condition they deem to have been pre-existing, even if it was undiagnosed, they can deny the claim and simply refund the premiums. So you could pay for 23 months thinking your family is safe, only for them to get nothing but a check for the money you already paid. This entire sales process is built on information asymmetry. The salesperson knows everything about the product's weaknesses, its high cost, its restrictive clauses. You, the new homeowner, know only the fear they've instilled and the simple solution they are offering. They have the script, the rebuttals to your objections, and the emotional triggers all mapped out. You have a brand new mortgage payment and a deep-seated desire to do the right thing. It's not a fair fight. People don't buy mortgage protection insurance because they've done a spreadsheet analysis and concluded it's the best financial option. They buy it for the same reason people buy a lottery ticket when the jackpot is high, not because it's a sound investment, but because it's an emotional purchase that offers a sliver of hope or, in this case, a dose of relief from anxiety. It's a transaction that happens in the heart, not in the head. The marketers and salespeople know this. They have reverse-engineered the psychology of a new homeowner and built an entire industry around that single moment of vulnerability. They are selling you an expensive, inflexible, and inefficient product by convincing you it's a simple, necessary utility, like turning on the water or the electricity. They've made it feel like a non-decision, a box you just have to check. But it is a decision, and it's a critically important one. Understanding the psychological tricks and marketing tactics is the first step to taking back control. It allows you to see the letter in the mail not as an urgent notice, but as what it truly is, a cleverly disguised, unsolicited sales pitch. It allows you to see the salesperson in your living room not as a concerned advisor, but as a commissioned agent executing a well-rehearsed script. Now that we've pulled back the curtain on how they sell it, it's time to dig into the fine print of what they are actually selling. Because hidden within the policy documents themselves are the traps, the loopholes, and the clauses that can make these policies worth even less than you think. The devil, as they say, is in the details, and with mortgage protection insurance, those details can be absolutely devastating. So let's pull back the curtain on the single most dangerous detail hidden in many of these mortgage protection policies. It's a practice so predatory it frankly should be illegal. It's called post-claim underwriting. Now, that sounds like boring insurance jargon, but I want you to understand what it means in the real world. When you get a traditional life insurance policy, the kind we'll talk about later, the company does its homework up front. This is called underwriting. They pull your medical records, they check your driving history, they ask you detailed health questions. They do all this before they take a single dollar from you. They are verifying your risk profile so that when they issue that policy, it's a rock-solid contract. They are giving you their promise that if you hold up your end of the bargain by paying your premiums, they will hold up theirs and pay the claim. Post-claim underwriting flips that entire process on its head. With many of these direct mail mortgage protection plans, the underwriting is minimal, if it happens at all. They might ask you a few simple yes or no questions on an application. Feels easy, it feels convenient. You get approved in minutes. You start making your payments, feeling secure, feeling like you've protected your family. But you haven't bought a promise. You've bought a lottery ticket. Because the real underwriting, the deep dive investigation into your life, only happens after the unthinkable occurs. It happens after you die or become disabled. It happens at the exact moment your grieving family files a claim, desperate for the financial safety net you thought you had put in place. At that point, the insurance company launches a full-scale investigation. They will subpoena every single medical record you've ever had going back decades. They will scrutinize every doctor's visit, every prescription, every note a nurse ever scribbled in a file. And they are not looking for a reason to pay the claim. They are looking for a reason to deny it. They are searching for any discrepancy, no matter how small or unintentional, between the life you lived and the simple answers you gave on that form years ago. Let me paint you a picture. Imagine a man named David. He's 45, gets one of these MPI offers in the mail. One question asks, in the last 5 years, have you been treated for or diagnosed with any heart or circulatory issues? David, in good faith, answers no. He feels healthy. He forgets that 4.5 years ago, he went to an urgent care clinic for what he thought was bad heartburn after a spicy meal. The doctor ran a quick EKG just to be safe, said it looked fine, told him to take an antacid and sent him home. It was a non-event. A 30-minute visit he never thought of again. 3 years later, David has a sudden massive heart attack and passes away. His wife, devastated but trying to hold everything together for their kids, files the MPI claim. The company initiates its post-claim underwriting. They pull his records and they find that urgent care visit. And just like that, the claim is denied. The reason? Material misrepresentation. They argue that his heartburn was a circulatory event, and by answering no, he voided the policy from the start. It doesn't matter that it was an honest mistake. It doesn't matter that the urgent care doctor told him he was fine. It doesn't matter that he paid his premiums faithfully for 3 years. The company gets to keep all that money, and his family gets a denial letter and a foreclosure notice. This is not a rare, hypothetical scenario. This is the business model. The ease of getting the policy is the bait. The post-claim investigation is the trap. But it doesn't stop there. Let's talk about another insidious piece of fine print, the actively at work clause. This is a real gem. Many policies, especially those with disability riders, state that for the coverage to be valid, the insured person must be actively at work on a full-time basis on the date the policy is issued. Think about what that means. Let's say you sign up, get your approval, and your policy's effective date is set for Monday, March 1st. But over the weekend you come down with a nasty flu. You're a responsible employee, so you call in sick on Monday. You're not actively at work. According to the fine print of that contract, your policy never actually went into effect. The same could be true if you took a planned vacation day, or were recovering from a minor outpatient procedure. If you aren't physically at your job, performing your regular duties on that specific day, some companies can argue the contract is null and void. They'll happily keep collecting your premiums for years, but when you file a claim, they'll point to that one day and say, sorry, you were never technically covered. It's a loophole big enough to drive a moving truck through. Then you have the minefield of exclusions. You assume a life insurance policy covers you if you die. Simple, right? Not so fast. These MPI policies are often riddled with very specific and broad exclusions. Beyond the standard 2-year suicide clause found in most policies, you'll find exclusions for death resulting from an act of war, which can be interpreted very broadly in today's world. They'll exclude death during the commission of a felony, which seems reasonable until you realize how many minor offenses can be escalated to a felony charge. But the most common trap here is hazardous hobbies and avocations. Do you ride a motorcycle? Do you scuba dive? Do you have a private pilot's license or even just enjoy rock climbing on the weekends? Many of these simplified policies will have blanket exclusions for these activities. You could be the safest pilot in the world, but if you die in an accident involving a private plane, your policy is worthless. You're paying for a sense of security that evaporates the moment you engage in a part of your life you truly enjoy. A proper, fully underwritten insurance policy would ask you about these hobbies up front. They might charge you a slightly higher premium to cover that risk, but you would be covered. With these cheap MPI policies, they don't ask. They just put the exclusion in the fine print and hope you never read it. Finally, let's talk about the fundamental design flaw that makes this product a terrible deal for almost everyone. It's tied to your mortgage. Your policy, your protection, is shackled to that specific loan with that specific lender. What happens in 2, 3, or 5 years when interest rates drop and you want to refinance to save hundreds of dollars a month? In most cases, when you pay off that original mortgage, your mortgage protection insurance policy terminates. It's gone. Now you have to start all over. But you're older now. Maybe you've had a minor health scare. Maybe you've developed high blood pressure or your cholesterol is a little high. When you apply for a new policy to cover your new refinanced mortgage, you're either going to pay a much higher premium, or you could be denied coverage altogether. You are punished for making a smart financial decision. You're trapped. You either stick with your high-interest mortgage to keep your insurance, or you refinance for a better rate and risk losing your coverage entirely. It's a financial house of cards. And it stands in stark contrast to personal life insurance, which belongs to you, not the bank. It's portable. It goes with you when you move, when you refinance, when you change jobs. It provides a stability that MPI, by its very design, can never offer. These aren't just minor details. Post-claim underwriting, actively at-work clauses, hidden exclusions, and the refinancing trap. These are foundational flaws designed to protect the insurance company, not your family. They create a product that looks like a safety net, but when you actually fall, you discover it's full of holes. So if the net sold by the banks is full of holes, does that mean you should just give up and hope for the best? Absolutely not. It means you need to find a better net. One that's actually designed with your family's safety in mind. One that isn't tied to the very bank that holds your debt. And for the vast majority of American homeowners, that superior safety net has a name: term life insurance. Now, I know what some of you might be thinking. Life insurance? Isn't that something completely different? I just want to protect my mortgage. And that is the single biggest misconception that lenders and MPI companies rely on. They want you to think of mortgage protection as a unique, specialized product. But in reality, it's just a less effective, more restrictive, and often more expensive version of a standard term life insurance policy. Let's break this down piece by piece and compare them head to head. I want you to see with crystal clarity why one is a flawed tool and the other is a powerful solution. First, let's talk about the most important number: the payout, or what's called the death benefit. As we covered, with mortgage protection insurance, that benefit is a ticking clock, constantly decreasing. You start with a $300,000 mortgage and a $300,000 policy. 10 years later, you've paid your mortgage down to $200,000. If you pass away, the MPI policy pays out $200,000. You've been paying premiums for a decade on a $300,000 promise, only to have the actual value shrink every single month. You are literally paying the same or even more for a benefit that is guaranteed to be worth less over time. Now, let's look at a 30-year term life insurance policy. You get a $300,000 policy to cover your $300,000 mortgage. If you pass away on day one, your family gets $300,000. If you pass away 10 years in, when the mortgage is down to $200,000, your family gets $300,000. If you pass away in year 29 with only a few thousand left on the loan, your family still gets the full, original $300,000. The benefit does not decrease. It is level for the entire term. From a purely financial standpoint, the choice is obvious. Why would you ever choose a shrinking asset over a stable one? Second, and this is arguably even more critical, who gets the money? With MPI, the check is written to one entity and one entity only, the lender. Your family never sees a dime. The bank pays itself. Your loved ones have no say, no control, no flexibility. The debt is gone and that's it. With term life insurance, the beneficiary is whomever you choose. Your spouse, your children, a trust. The insurance company writes a tax-free check directly to them. This single difference changes everything. It puts the power back where it belongs, in your family's hands. Let's revisit that scenario. The mortgage is down to $200,000, but your family receives a check for $300,000. What can they do? They can, of course, pay off the $200,000 mortgage immediately, securing the house. But now they have an extra $100,000. That money can be a lifeline. It can replace lost income for a year. It can cover funeral expenses. It can pay for childcare, car payments, or urgent repairs on the house. It can be put into a college fund. It provides options. It provides breathing room during the most difficult time of their lives. MPI offers one blunt solution: pay the bank. Term life insurance provides a flexible financial tool that your family can use to solve their most pressing needs, which might be the mortgage, but it could also be something else. It gives them the dignity of choice. Third, let's talk about cost. You would assume that for a shrinking benefit that only pays the bank, MPI would be significantly cheaper. But you would be wrong. Because of that simplified underwriting we talked about, where they don't ask many health questions up front, they are taking on a bigger risk. And how do insurance companies handle bigger risk? They charge higher premiums to everyone. For a healthy individual, a fully underwritten term life insurance policy is almost always less expensive than a comparable mortgage protection policy. Let's run some real-world numbers. A healthy 35-year-old non-smoker looking to cover a $500,000, 30-year mortgage. An MPI policy might be quoted at anywhere from $70 to $120 a month, or even more. That same person could likely get a $500,000, 30-year level term life insurance policy for $35 to $50 a month. So, you're paying potentially double the price for a benefit that decreases over time, that you have no control over, and that only pays the bank. It makes absolutely no financial sense. Fourth, let's destroy the refinancing trap. Remember how if you refinance your mortgage, your old MPI policy is toast? You have to reapply, and now you're older and maybe have a new health condition, so your rates skyrocket. It's a nightmare. Term life insurance has zero connection to your mortgage loan. It is a personal contract between you and the insurance company. You can refinance your mortgage 10 times, you can sell your house and move to a different state, you can pay off your mortgage entirely and go live in a yurt in the wilderness. Your term life policy doesn't care. It stays with you with the same locked-in premium for the entire term. It provides a stable, predictable layer of protection that isn't held hostage by your mortgage details. This portability is a superpower that MPI simply does not have. Finally, let's talk about certainty. The dirty little secret of simplified issue MPI is post-claim underwriting. The idea that the insurance company does its real investigation after you've passed away, looking for any reason in your medical history to deny the claim. It's a recipe for disaster. Term life insurance works the opposite way. It is fully underwritten up front. Yes, this means there's an application process. You'll answer detailed health questions, and they'll look at your medical records. There's often a simple medical exam, where a nurse comes to your home. It might seem like more of a hassle, but what you are buying with that process is certainty. Once that policy is approved and issued, it is a rock-solid contract. As long as you were truthful on the application and you pay your premiums, the insurance company will pay the claim. There are no surprises, no last-minute investigations for your grieving family to deal with. You do the work up front so they don't have to deal with a potential denial later. So let's recap the matchup. MPI versus term life. Decreasing payout versus a level payout. The bank gets the money versus your family gets the money. Less flexibility versus total flexibility. Often more expensive versus typically less expensive. Tied to one loan versus completely portable. And the risk of denial later versus certainty up front. This isn't a close call. It's not a matter of preference. For the specific goal of making sure your family can keep their home if you're gone, term life insurance is a fundamentally superior financial instrument in every measurable way. It's not just an alternative, it's a comprehensive upgrade. It takes the one good intention of MPI, protecting the home, and executes it in a way that is smarter, cheaper, and profoundly more beneficial for the people you are trying to protect. Now, establishing that term life insurance is the right tool for the job is the first giant step. But it immediately leads to the next, equally important questions. If you have a $500,000 mortgage, do you need exactly $500,000 of coverage? And if you have a 30-year loan, do you automatically need a 30-year term? The answers aren't as simple as you think, and getting them wrong can mean either paying for coverage you don't need, or worse, leaving your family tragically underprotected when the time comes. Let's start by tackling the first, most fundamental question. How much coverage do you actually need? The knee-jerk answer, the one mortgage lenders and insurance agents love, is simple. Get a policy that matches your mortgage balance. Got a $400,000 loan? Get a $400,000 policy. Seems logical, clean, and easy, but it's also dangerously incomplete. It's like putting a state-of-the-art fire extinguisher in your kitchen, but leaving the rest of the house filled with gasoline-soaked rags. Paying off the mortgage is a fantastic goal, but it's only one piece of a much larger financial puzzle your family would face if you were gone. What about the car payments? The student loans? The thousands of dollars in credit card debt that so many American families carry? If your income disappears, those debts don't. They become an immediate, crushing weight on your surviving spouse. And what about your income itself? The mortgage might be paid, but the lights still need to be on. The cars still need gas. The kids still need to eat, get braces, and go on school trips. A paid-off house doesn't pay the property taxes or the homeowner's insurance. It doesn't fund a retirement account. Your income does that. And protecting your family from the sudden catastrophic loss of that income is arguably even more important than just paying off the house. So, how do you calculate a number that truly protects them? There's a simple, powerful acronym used by financial planners called the DIME method. DIME. Debt, income, mortgage, and education. This isn't just about covering one bill. It's about recreating the financial security you provide. Let's break it down. First, D is for debt. This is everything except your mortgage. Go ahead and add it all up. Your car loans, personal loans, student debt, and every single dollar of your credit card balances. This is the first number. For many families, this alone can be $50,000, $60,000, or even over $100,000. Next, I is for income. This is the big one. The standard rule of thumb is to replace your income for at least 10 years. Why 10? It provides a long, stable runway for your family to adjust to a new reality without financial panic. It gives your spouse time to grieve, to be there for the children, and to figure out their own career and financial future without being forced to make desperate decisions. So, if you make $80,000 a year, you'd multiply that by 10 for $800,000. This number alone often dwarfs the mortgage. Then M is for mortgage. This is the straightforward part. You take the full remaining balance of your mortgage and add it to the total. This is the component that traditional mortgage protection insurance focuses on, but as you can see, it's just one part of the equation. Finally, E is for education. If you have children and you dream of helping them with college, this is where you account for that. The cost of a 4-year degree is staggering and only going up. A conservative estimate might be $100,000 per child for a public university, and far more for a private one. You add this final number to the pile. So let's see what this looks like for a typical American family. Let's say we have a couple in their mid-30s with 2 young kids. They have a $400,000 mortgage. They have $30,000 in car loans and $20,000 in student debt, for a total of $50,000 in non-mortgage debt. The primary earner makes $75,000 a year, and they want to set aside $100,000 for each child's college fund, so $200,000 total. Let's do the math using DIME. D for debt, $50,000. I for income, $75,000 times 10 years is $750,000. M for mortgage, $400,000. E for education, $200,000. You add that all up, $50,000 plus $750,000 plus $400,000 plus $200,000. The grand total? $1.4 million. Now compare that number, $1.4 million, to the simple $400,000 that would just pay off the mortgage. It's not even in the same ballpark. A $400,000 policy would have left this family $1 million short of being truly secure. The house would be safe, but their entire future, their ability to maintain their quality of life, and their children's educational dreams would be in serious jeopardy. Now, I know what you might be thinking. $1 million+ policy sounds expensive, maybe even unattainable. And for some, it might be. But the point of the DIME method isn't to scare you. It's to show you the real number. It's to define what full protection actually looks like. If that number is out of reach, that's okay. The key takeaway is to see paying off the mortgage as the absolute minimum baseline, the starting point, not the end goal. Get as much coverage as you can comfortably afford with the dime number as your North Star. That brings us to the second critical question. How long should the policy last? This is the term in term life insurance. And just like with the coverage amount, the conventional wisdom is often wrong. The standard advice is to match the term of your policy to the term of your mortgage. If you have a 30-year mortgage, you get a 30-year term policy. Simple, right? But again, this advice is centered on the lender's perspective, not your family's. The bank cares about its loan for 30 years. But your family's period of greatest financial vulnerability probably isn't 30 years. Your financial needs are dynamic. They change over time. The real question you should be asking is, when will I be self-insured? In other words, at what point in the future will you have enough savings, investments, and retirement funds and few enough dependents that the financial impact of your death would no longer be catastrophic for your family? Your life insurance policy is a bridge to get you to that point. You only need the bridge to be long enough to cross the canyon. Let's look at two different families. First, consider a couple who are 28 years old. They just bought their first home with a 30-year mortgage and they have a newborn baby. For them, a 30-year term policy makes perfect sense. Why? Because it covers the entire timeline of their most significant financial responsibilities. Over the next 30 years, they will raise their child from a baby to an independent adult. They will pay down the vast majority of their mortgage. They will build their careers and hopefully their retirement savings. A 30-year term acts as a comprehensive safety net across that entire, long, vulnerable period. By the time the policy expires when they are 58, their child will be 30, the house will be nearly paid off, and they should have a substantial nest egg built up. They will have crossed the bridge. Now let's look at a different family. A couple who are 45 years old. Their kids are 12 and 14. They just moved to a new school district and took out a new 30-year mortgage. Should they get a 30-year term policy? According to the conventional wisdom, yes. But let's think it through. A 30-year term would cover them until they are 75 years old. Is that necessary? Probably not. Their period of greatest need is the next 15 to 20 years. In 20 years, they'll be 65. Their kids will be 32 and 34, long since independent. They will be at or near retirement age, and their financial goal is to be living off their accumulated assets, not their income. For this family, a 20-year term is likely a much smarter, more efficient choice. It provides a massive safety net during the exact window they need it most, while the kids are still at home and heading to college, and while they are in their peak earning years trying to max out their retirement savings. It protects them right up to the finish line of financial independence. And because a 20-year term is significantly cheaper than a 30-year term, they can either save that money or, better yet, afford a much larger death benefit for the same monthly premium, providing even more protection during those critical 2 decades. The goal is not to have life insurance forever. The goal is to have it for exactly as long as you need it. You align the policy's expiration date with your financial independence date, not your mortgage payoff date. So, you've now seen that the amount of coverage and the length of the term are deeply personal decisions that go far beyond the numbers on your mortgage statement. They depend on your debts, your income, your kids' ages, and your long-term financial plan. It requires a shift in thinking, from protecting the house to protecting your family's entire future. Once you've wrestled with these 2 decisions and have a clear idea of the coverage you need and for how long, you're ready to take the next step. But this is where so many people, even with the best of intentions, make critical errors. These are the mistakes made not in the planning, but in the actual application and setup of the policy. These are the subtle but devastating errors that can cause an insurance company to fight your family's claim, delay payment for months or even years, or in the worst-case scenario, deny the claim altogether, leaving your loved ones with nothing. And that, right there, is the ultimate betrayal of the promise you thought you were buying. You paid your premiums faithfully, month after month, year after year, believing you had secured a safety net. But because of a detail buried in the fine print, because the underwriting was done after the fact, your family is left fighting a legal battle at the exact moment they are most vulnerable. It's a financial nightmare layered on top of a personal tragedy. So how do you avoid this? How do you ensure that the money you spend on protection actually provides real, ironclad protection? You do it by taking control of the process yourself, by sidestepping the one-size-fits-all bank-centric product and opting for a solution that puts your family, not your lender, first. The answer, for the vast majority of American homeowners, is not mortgage protection insurance. It is a properly structured term life insurance policy. Let's break down exactly why and what steps you need to take to put this superior protection in place. First, let's revisit the core differences. Remember, mortgage protection insurance, the kind pushed by the lenders, typically has a decreasing benefit. As you pay down your mortgage, the potential payout shrinks, but your premium often stays the same. You're paying the same price for a product that is worth less every single month. A term life policy, on the other hand, has a level death benefit. If you buy a $1 million 30-year term policy, it will pay out $1 million whether you pass away in year 1 or year 29. The value doesn't erode over time. Second, flexibility and control. MPI pays the bank directly. Your family never sees a dime. The money is locked into one single purpose: paying off the mortgage debt. But what if paying off the mortgage isn't the most pressing need at that moment? What if your surviving spouse needs that money for childcare so they can go back to work? What if they need it to cover medical bills, or to keep the lights on and food on the table for the first year while they figure things out? A term life policy pays a tax-free, lump sum death benefit directly to the beneficiary you choose, your spouse, your children, a trust. They get the cash, and they get to decide how to best use it to navigate their new reality. They could pay off the mortgage, yes, but they could also invest the money and use the returns to make the mortgage payments, preserving the principal for other needs. They have options. MPI gives them zero options. Third, and this is a big one, is cost. Because term life insurance is a highly competitive market with dozens of companies vying for your business, and because it is medically underwritten up front, it is almost always significantly cheaper than MPI for the same initial amount of coverage. Healthy individuals can often secure hundreds of thousands or even millions of dollars in coverage for the price of a few pizzas a month. You get a larger, more flexible, non-decreasing benefit for less money. It's one of the few times in finance where the superior product is also the cheaper one. So, what is the action plan? What are the concrete steps you should take starting today to protect your home and your family the right way? Step 1 is to determine your actual need. Don't just think about the mortgage balance. That's what the bank wants you to think about. You need to think like the CEO of your family. Calculate your total need. A simple way to do this is with the DIME method. D is for debt. Add up your mortgage, car loans, student loans, and credit card debt. I is for income replacement. How many years of your income would your family need to maintain their standard of living? A common rule of thumb is 10 to 12 years. So, if you make $80,000 a year, that's $800,000 right there. M is for mortgage, which we already covered under debt. And E is for education. If you have children, how much do you want to set aside for their college education? Add all of those numbers up. That is your true protection number. It's probably a lot bigger than just your mortgage balance, and that's okay. That's why we're doing this. Step 2 is to shop the market. Do not just go with the first company you see. Go to an independent insurance broker, or use a reputable online marketplace that allows you to compare quotes from a dozen or more A-rated insurance carriers simultaneously. This is critical. A quote from one company for a 30-year, $1 million policy might be $70 a month, while another might be $120 for the exact same coverage. Shopping the market can save you thousands of dollars over the life of the policy. Step 3 is the application and underwriting process. This is where term life insurance proves its superiority. You'll fill out an application and, in most cases, complete a simple medical exam, which is usually free and can even be done at your home. They'll check your height, weight, blood pressure, and take blood and urine samples. This is a good thing. This is the insurance company doing its due diligence up front. They are verifying your health status before they issue the policy. This means that once the policy is in force, as long as you were truthful on your application, the claim will be paid. There's no post-claim underwriting. No risk of the company digging through medical records after the fact to find a reason not to pay. The deal is locked in from the start. Step 4 is to set up the policy correctly. When you get your policy, you must name a primary beneficiary and a contingent or secondary beneficiary. This should be a person or a trust you have established. Never, ever name the bank as your beneficiary. The primary beneficiary is the first person in line to receive the payout, and the contingent beneficiary is the backup in case the primary has also passed away. This ensures the money goes exactly where you intend it to go, into the hands of your loved ones with no ambiguity. And finally, step 5 is to review your coverage periodically. Life isn't static. You might have another child, buy a bigger house, or get a significant raise. It's a good practice to review your life insurance coverage every few years, or after any major life event, to ensure it still aligns with your family's needs. Your 30-year term policy is your foundational protection, but you may find you need to add another smaller policy later on. Look, I know this can feel overwhelming. We've talked about underwriting, beneficiaries, and acronyms, but let's boil it all down to one simple choice. The choice is between a product designed to protect a bank and a product designed to protect your family. It's the choice between a benefit that shrinks every month and a benefit that remains strong and steadfast for decades. It's the choice between a restrictive policy that locks your loved ones into one single action and a flexible one that gives them the freedom and resources to rebuild their lives on their own terms. It's the choice between a policy with potential underwriting traps that can surface at the worst possible time and a policy that is vetted, approved, and guaranteed from day one. When you bought your home, you didn't just buy drywall and a foundation. You invested in a future. You invested in a place for your family to grow, to be safe, to make memories. That home is the backdrop to your entire life. Protecting the financial obligation of the mortgage is part of the equation, but it's the smallest part. The real goal is to protect the people inside that home, to ensure that if the unthinkable happens, their lives are disrupted as little as possible, that they don't have to face the trauma of losing a parent or a spouse, and then face the trauma of losing their home, their school, and their community in the same year. The peace of mind that comes from knowing you have done this the right way is immeasurable. It's not just a line item in your budget. It is the silent promise you make to your family that says, no matter what happens to me, you will be okay. You will be secure. This home, this life we have built, will continue. So, your homework, if you choose to accept it, is simple. Tonight, take 10 minutes. Go to a free online life insurance needs calculator and run your numbers using the dime method. You don't have to buy anything. You don't have to talk to anyone. Just take that first crucial step of understanding what your true need is. Arm yourself with knowledge, because protecting your family's future is the most important financial decision you will ever make. Don't leave it to a default option in a lender's letter. Take control, get the right protection, and secure your legacy.